Now I'd like to introduce Pat Roche, Chief Executive Officer, and Jennifer Walter, Chief Financial Officer of Moog. Moog designs and manufactures high-performance motion and fluid control systems for aerospace, defense, industrial, marine, and medical applications. Its segments include space and defense, military aircraft, commercial aircraft, and industrial. Moog has around 31.7 million shares outstanding for a market cap of around 6.2 billion and $1 billion of net debt. So with that, maybe we could just start with a brief overview and history of Moog, just to familiarize the audience.
Absolutely. If you go on to the next slide, we have a forward-looking statement. You all know it in the audience, but you should read it anyway, in case we say anything about the future in this talk. Moog is a technology company, is how I would describe it. So we shape the way the world moves. So it's all motion control stuff. Technologies extend from precision components all the way through to highly integrated systems of systems. So highly engineered products throughout the organization that are best in class. We have a collaborative culture as an organization, actually, which has two advantages for us. It helps us attract and retain staff in the organization, so talent. And secondly, it helps us develop really high-quality solutions with our customers because we really get involved with them in solving their deep technical problems. And then the applications we go after are typically difficult to solve. They're in application areas where performance really matters. It can be mission critical. It can involve safety of flight. And so they're challenging applications themselves, and they're across a diverse range of end markets. So that sort of characterizes, in a thumbnail sketch, the company overall. And then if I think about our journey over the last 3 years, we've been on a transformation journey to drive improved margins as an organization. I think we've been very successful at driving that agenda within our company. We've just completed an exceptional quarter, record sales in several segments within the company, record adjusted EPS as well. So the company is performing very well at the moment. We're very excited about the opportunities ahead of us as well.
Maybe just on that note, we could talk about some of the opportunities you're seeing in defense and the growth there, just internationally and domestically.
Yeah, I mean, people would have seen the budget reconciliation that went through. You got, $1 trillion plus budget in the US. You got a huge increase in spend in the NATO countries as well, moving from 2% to 3.5% GDP on the core defense spending. So overall, globally, defense spending is increasing significantly. That creates huge opportunity for us as a company, since 50% of our business is around the defense markets. You see that in a whole host of areas. So if I focus on the US side, you've got priority areas that include Golden Dome, new technologies such as hypersonics, readiness of the fleet, the nuclear triad. There's significant administration agenda items or priorities that are well aligned with the capabilities we have as a company, both for the core products we have and for the engineering capability to develop new solutions in these spaces as well. If I take Golden Dome as an example, it's a sort of a layered defense approach, but you can see that it requires many of the elements that we already have as a company. So starting in space, you got to detect incoming missiles and track them. You need a lot of new capabilities in the space domain to be able to do that. We have a business which is a 60-year heritage in space components, but in the last 5 years or so, we've started moving into space vehicles where we actually can build up a full satellite ready for a payload to be loaded onto it. And our technology is particularly suited to defense applications. So avionics, which is more rugged against radiation, can stay in space longer, can stay at higher altitudes and perform. And also chemical propulsion, which allows you not just to have a satellite maintained on orbit, but to move it quickly from its station position if you've got an incoming debris or missile coming towards that satellite. So our capabilities in space, we think, position us well to support the space element of Golden Dome. And then if you think about the layered missile defense, we announced in Q1 an order for PAC-3, which was over $100 million. So that's a core business of ours is missile fin control. So that was further building that business on a track record of 100% quality, 100% delivery for our customers that allowed us win share away from our competitor on PAC-3. We're also on the THAAD missile, and we have elements that support the triad as well. So we're well placed to provide support for the Golden Dome, but also to deliver on replenishment, because a lot of these armaments have been consumed over the recent conflicts. So I think we're well positioned. I think the market is strong, and I think we're benefiting from it.
Definitely. For something like Golden Dome, how do you think about the timeline and size of such a big opportunity like that?
It's hard for me to project exactly how long it will take to architect what Golden Dome is. I think what you have are core elements that are already available that will be utilized to deliver a solution. I mean, if I just think about the PAC-3, I mentioned the 100 million plus order that we got in Q1. The message we're getting from our customers is that a greater sense of urgency around this. As I said, missiles have been depleted in the conflicts that are going on. You need to rebuild the arsenal of missiles here and in the allied nations, and so that's putting greater pressure on us to pull forward or accelerate capacity growth to satisfy that demand.
And maybe just pivoting to European defense, you touched on a replenishment cycle. Maybe you could add a little more detail there and how you see that playing out.
Yeah, Jennifer, do you want to do that one?
Yeah, so on the international side, we certainly have a lot of opportunities. Everything that's happening from the geopolitical landscape out there is creating a lot of demand. We're positioned actually really nicely. We have industrial and defense businesses in Europe. We've got 10 manufacturing sites, over 3,000 employees, and there's lots of opportunities with everything that's going on in the world right now. So what we currently do is we're focused in our German facility on turret controls for turrets for military vehicles, and in the UK we're well positioned for military aircraft. But we have other facilities that can also supply and support the defense business as well. So certainly there's opportunities there. There's pursuits that we're going after, for instance, GBAD in the UK, for instance, leverages the technology and the innovations that we've done, for instance, for our reconfigurable integrated weapons turret as well.
Excellent. It sounds like a robust opportunity. And maybe just speaking on that note, since we just had Textron, maybe you could talk about FLRAA and the opportunity there.
Yeah, we're on the program with Bell on FLRAA, which is, I think, a really exciting program for us and will have an impact on our company for decades to come. We're in the engineering, manufacturing, and development phase at the moment, so our run rate in terms of revenue arising from the program is around $80 million or so, and we have about 120 engineers working the program. The sense we get from our customer and from the government around the program is that they would like to see it sooner, and so when we were expecting to complete the engineering, manufacturing, development phase, there was planned to be a slight pause before we get into production, but that now is looking like we want to reduce that and pull forward the ability to get into low-rate production with the program. So we're excited about that. We're ready for it. We're actually using new capabilities and tools in our development of the FLRAA program, digital modeling of components. So we're actually really delivering well and producing prototypes within the program. So we feel good.
Excellent. Just want to briefly pivot maybe to the commercial side, sure. Get your view on where you see the rate ramp going and how you see that progressing.
Yeah, I mean, if I think back to the last Paris Air Show 2 years ago, it was all conversations about supply chain challenges and the difficulties in attaining rate or ramping on the programs. Our exposure is mostly on the wide-body programs with Boeing and Airbus. I have a sense that we have much greater stability now. At least we feel that internally in our supply chains. So things have settled down quite a bit over the course of the last 6 months or so. And we look at our customers and what they're doing, and we have a greater sense of confidence that we are on a path to increase rate with them. Certainly, so our confidence level is increasing as well on the rate, and they still have the same aspirations. So Boeing to get to 10 787s by the end of next calendar year, and Airbus to get up to 12 by, I think it's 27. And so we're on a good path with that. Our production plans are loaded in line with that. And we don't see any challenges at the moment from our side keeping that.
Excellent. And maybe you just talk to the operating leverage opportunity there as rates rise. the leverage Moog will benefit from.
Yeah, we mentioned it in our investor day back in 2023 that on the commercial side of our business, as we increase rate, that actually helps us on the margin side as well within the business. So, yeah, we're looking forward to the increase coming through. We still have a way to go to get up to the full rates that they're anticipating, but we're on plan, as I said.
And maybe just on the aftermarket side, you could talk about the strength there. Obviously, it's been very strong for a few years now, but I guess where do you see that going?
So as you mentioned, aftermarket sales in the commercial business are at a record level, so very robust, and we're seeing that robust level continue. But what's going on right now is we're seeing just air traffic is at a high. The A350 and 787, where we've got significant content, are being very well utilized, and we're also securing support work on a long-term basis with partners. And when we do that, we get a typical short-term type of bump in it. But we've had that in our second quarter, we've had that in our third quarter, and so we're seeing really robust levels of aftermarket. We do expect to continue to see that because we are expecting the flight levels to continue as A350 and 787 ramp. There continues to be support for that. However, as a percentage of sales for our commercial aircraft segment as a whole, it will decrease as a percentage as the production ramps that Pat referenced do go up.
Excellent. And maybe you could talk to the shift mix, as you mentioned, more utilization on the wide body. Has anything shifted in terms of the products you're shipping to the airlines, or?
No, I would say that that's relatively consistent. Yeah.
I think what we have is we have 3 channels to market on the aftermarket side. So we do time and materials work for some customers. We work with the integrators. So we work with the OEMs firstly in support of their aftermarket programs. We work with the technical integrators like Lufthansa and Finnair Technical Services, and we work directly with the airlines. And over time, we're shifting our book of business more over towards the long-term contracts. You can call them power by the hour or whatever, but 10-year support contracts with the major airlines that have significant fleet of 787 or A350. So that's a sort of pushing it towards a part of our book of business where we have a much longer term commitment with the customer, and we secured that aftermarket content for a long time to come. So at the Paris Air Show, we announced a renewal of a 10-year contract with ANA, which is one of the first airlines to operate the 787. So a decade of support to them and a further decade now committed. So we're pretty pleased with our ability to move over to those longer term contracts.
And I guess on that note, what are you seeing in the military, aftermarket?
One of the initiatives that's called out in the last budget reconciliation is ensuring readiness, and readiness means that I have to have my fleet available for use. And so we're seeing a lot more work coming through on V22 and securing orders on aftermarket support for V22. And we also announced, I think it was in Q1, a support deal on the B-2 bomber, where we're reworking the entire flight control systems that we supplied. So it's an upgrade, overhaul of the flight control. So there is a lot more being spent on the readiness side on the military aftermarket.
Excellent. And just maybe looking back the last quarter, space and defense, there's significant momentum, sales up double digits. Maybe you could just give a little more color on what's driving that. We already talked about some of the programs, but anything else there?
So I think on the space and defense side, it's a sort of a broad-based set of demands that's coming into the organization. I mean, in particular in the quarter, we had missile activities that were driving our sales. Is there anything else to add to that?
No, it's just a general broad-based demand, as Pat referenced. We're seeing that strength, we're seeing that continue, and we've seen it for several quarters, actually a couple of years, and we are seeing that continue as well. So it's just everything that's going on in the environment is contributing to the demand that we're going. Space and defense is an exciting opportunity area for us. This is where we're seeing opportunities that you see only kind of the once-in-a-generation type of opportunities that we've referenced. Well, we've seen several of them all at once, and so it's just a opportunity-rich environment for us.
I guess one thing I wanted to touch on, which you've had a lot of success with is the 80/20 simplification strategy. Maybe you could talk more to that and tell us what's left there.
Sure. So we're a few years into our 80/20 journey at this stage. I think it still remains a really exciting and foundational element of how we work in the company now. When we started working with 80/20, we saw it as a project or maybe an initiative, another tool in our kit bag to help drive continuous improvement in the organization. But as we've developed our own capability in that area, it's much more fundamental to us and central to our improvement activities. So when we start now thinking about driving improvement at a site, we start with 80/20. And we take an 80/20 lens looking at the products and the customers that we have flowing through that facility, do some really data-driven analysis to project, where's profitability coming from, what business decisions do we need to take to change the dynamic or change the financial performance at that site. And that's been really insightful. That's really a simplification activity. And that's always been our starting point with using 80/20. But we're moving it on through the organization now. So we have it deployed to around 85% of the revenue generation within the company. So it's pretty broad-based at the moment within our organization. And I would say the stage we're on now is further maturing its application within our company. So we start with the simplification that I just described, but we move on to segmenting our P&Ls. It's not activity-based costing, but it's actually beginning to assign indirect resources to the customer or value stream that they're supporting and getting a much better view on where profitability sits within the organization and then making business decisions around that. And so, even in the last quarter when we've taken it to another site, we've identified a couple of product lines. Now we're questioning what we're doing with these are smaller in terms of the materiality of them to the company at the top level, but they're the type of examples at a site level where you say, okay, I have a profit leakage in this piece of business. I need to do something about it and make decisions. And so it's really driving good business decisions at a site level within the organization. And then as it matures, you move on to then properly resourcing what we would call the A customers and the A products. These are the customers that are strategically important to us, and we're beginning to differentiate our offering to those customers to ensure that they are excited by placing more business with Moog. In the last quarter, you saw a couple of things that we did that arise from the 80/20 work we've done. So we sold a pneumatics product line in the UK that was emergency flotation devices for helicopters and evacuation chutes for aircraft. It's not a core business of ours. It's a distraction at the site level running those businesses. And so we decided to divest those. On the military aftermarket side of the business, we put in place a distribution agreement to cover foreign military support of our product in the field, which takes away a significant amount of transactional effort on our side to support small quantity orders in different parts of the world. And so now we have a stocking distributor that handles that. And so these things all arise from the 80/20 activities that we're doing, streamlining and simplifying the work that we're doing internally, driving our overall effectiveness as an organization and our productivity. I gave a statistic in the quarterly call that we shipped 10% more product with the same number of people as last year. So we had a 10% productivity gain this quarter over the year ago quarter. I think that's arising from the activities we're driving throughout the organization. So I see more potential in it. To answer the last part of the question, we're still maturing it and driving it into the organization. It becomes a way of thinking and a way of approaching problem solving within the company. And now you start turning that lens to, well, how do I increase velocity or flow of materials through the organization as well, which I think will have a longer term impact. It'll take time to do that, but it's also going to come from the 80/20 work that we're doing. So yeah, it's still got a lot of potential for us. It's core to what we're doing now.
Excellent. It definitely sounds like there's still a lot left. I guess maybe on pricing, that's been a part of it. How much opportunity is left there, maybe on the aftermarket side?
Yeah, so on the pricing side, I've referred to it in a couple of calls now as the pricing is embedded as sort of business as usual into the organization. If I went back to the Investor Day, I would have said pricing and simplification were the two major initiatives we were driving. The pricing, we took a lot of improvement from renegotiating some of our large, more significant customer contracts even before we got into the Investor Day back in 2023. But subsequent to that, we've continued to work down through our book of business across all of the end markets we're in and driven pricing activities there. So that it has been really important to us in our journey, and it continues to be a focus for the teams as well. And so as new contracts come up for renewal, existing legacy contracts come up for renewal, we're repricing those as we go. So it continues.
Excellent. Maybe just touching on tariffs and the potential risks there. I guess what's the current status, and I guess what could be a concern?
So on the tariffs, that's been quite an investment of time and effort over the course of the last number of months. So we had to stand up mitigation approaches to help reduce the impact of tariffs on the organization. We had Liberation Day followed by the 90-day pause. So our Q3 was effectively seeing country tariffs of 10% and seeing steel and aluminum tariffs of 25%, and then working out how to mitigate all those tariffs, and in anticipation that country rates were going to increase in Q4. So we put in place a number of mitigation activities, fully utilizing the US-Mexico-Canada agreement, because we have some components being produced in Mexico that are brought in, some sensors that come from Canada. So there's some product moving around in support of our business from those two countries. And also looking at import and re-export of repair materials. So if an airline somewhere in the world wants to send something back to the US, making sure we're doing all the paperwork so that we're not attracting undue levels of tariffs on that. And then finally looking at pricing as an approach to mitigate some of the increases. And if I talk about our medical device business, we have a large facility in Costa Rica. Costa Rica has a 19% tariff at the moment. There's no exemptions or exclusions from that. And so we have to work out how to deal with that within the business, which involves having conversations about pricing. So we've pursued all of those methods. I would say during Q3, we were getting up to speed and getting them in place. So they weren't 100% effective during Q3. Q4, they'll be much more effective in their implementation, but the tariff rates in certain countries are higher at this point as well. So they sort of offset one another a little bit. But we estimated that between $15–20 million was the impact on our operating margin from tariffs for that second half of fiscal 25. Going forward, we have yet to do the guidance for 26. I don't think you can take that $15–20 million and just double it for next year, because of the fact that we still have fluidity on the tariffs scene, and our mitigations are becoming more effective. In fact, we've introduced additional items, so aerospace components are excluded from some of the tariffs in some of the regions, and we're making use of that. And in certain of our defense programs, we've got program-specific exceptions from the tariffs as well. So we continue to drive the mitigation activities.
Excellent. I'd like to just touch briefly on the industrial business and some of the medical opportunities you're seeing there.
Okay. On industrial, it's been, as you know, for our company, it's a watch item for the last couple of years as the industrial business was slowing down in Germany. I think, and over the last couple of quarters, I've said that we have relative stability on our industrial business. It's not declining. In fact, if I look at our book-to-bill ratio in the quarter, it was greater than 1, and our backlog had increased from the prior quarter. So I think we're stable on the industrial side of the business. I think industrial automation in Europe has actually been a little bit more resilient than we expected over that period of time. So all in all, I think industrial is in good shape. Inside in our industrial segments, it's the medical device business. That business has been doing pretty well. I think it's a testament to operational excellence within the company. We have a plant down in Costa Rica that I just previously mentioned that's a Shengo medal winner for lean continuous improvement in their site. And I think our customers on the medical device side of the business appreciate the consistency with which we're able to deliver product to them and the quality of the product. So in terms of compliance and continuous improvement, I think we do an excellent job. And that then means that we have one share on the IV and enteral side of the business from competitors.
Excellent. Maybe you could just talk about the acquisition you recently did, the Cotsworth acquisition, just talk about the opportunity there.
Yeah, so that's a great opportunity that we have. It's about a $30 million business. They do ruggedized fiber optic solutions for harsh environments. What's really nice about it is it complements what we do with our slip ring technology, so that when we combine their technologies with our existing platforms, that we can provide opportunities in the military space, defense space, for increased levels of data transfer. And so it's a great opportunity from a technology standpoint. It's also a nice, well-run company that's easy to plug into what we have. As Pat mentioned, we've been on a simplification journey, and we're making sure that we're not adding things unnecessarily, many sites and things like that. But they're a well-run company, integrates nicely with our technologies. We're already partnering together for solutions, so it's a nice fit for us.
Excellent. I'd like to just briefly turn to the audience and see if there's any questions.
Could you articulate your outlook for free cash flow over the next couple of years? And I was just looking at your proxy, and it looks like incentives are tied to EBITDA growth. Talk about why that's appropriate, or whether you might consider adding other elements. Thanks.
Yep. So I'll start with the free cash flow part on where we're doing it right now. So free cash flow has been pressured for us. So this year for 25, we're guiding to a 30 to 50% free cash flow conversion on net earnings. So that's where we're at. We're actually expecting a strong fourth quarter. Some of this is timing related. So we've got timing of compensation payments that just naturally benefits us in the fourth quarter and hurts us, for instance, in the first quarter. There's other things that we've built up, receivables for our strong level of sales that we'll have collections on, as well as collections on our customer advances as well. So there's definitely a timing element of that. Some of the underlying aspects of free cash flow generation is on our, what we term our physical inventories, which are our inventories on our balance sheet, as well as our unbilled receivables. That does include some margin on them. But those pieces of inventory that you can actually go into our factory and touch. We are working to slow down the incoming levels of inventory that we've had. Obviously, shortly after the pandemic, there was all sorts of supply chain issues. Those have largely resolved, with a few notable exceptions. So we're trying to get down to regular levels of buffer inventory, work those down. As we look into the future, we haven't put guidance out for 26 yet, but we do have our Investor Day targets out there that say that we want to target to get to 75 to 100%. And we think for us that's a long-term appropriate range. And depending on what's going to happen in certain elements, so for instance, we're seeing extreme levels of organic growth. And if we keep seeing those very high levels of organic growth, we'll consume more working capital. That'll push us down towards the lower end of the range. But we have some opportunities specifically in our commercial aircraft business that we've talked about, and those are structural changes. We're working on those changes right now. They do take a while to actually implement, because we are shipping parts from multiple locations across the globe, and so it has a very long cycle time. So we're working to structurally reduce the complexity there, have a shorter cycle time, which will reduce the levels of physical inventories that are needed for that part of the business. When we do realize that, that's taking some balance sheet inflation and taking that out of the picture. So that would suggest that would be an opportunity to be towards the higher end when we realize that. So it's really a timing of when we've got the levels of sales growth and when we're able to achieve some of the structural changes that we are starting to work on, but it is, you know, a multi-year journey on that front.
And on the incentives, what you described is what we put in place when I came into the role. So it was trying to align short-term and long-term with the Investor Day goals that we went out with. We continue to review the composition of those incentive plans, and so that's an ongoing discussion.
Any additional questions from the audience?
I hate to bring this up, but two analysts that are covering it right now have holds on the name. What do you guys think that they're missing right now as far as, you know, growth in the stock over the next 12 to 18 months at this point?
I can take that. Yeah, I think there's lots of opportunities. As far as folks missing something, I think there's different perspectives on different areas of the business. When we look at our business, as Pat mentioned, we're over 50%, just over 50% defense. We see lots of opportunity there. It's a strong business, strong margins associated with it, so we feel good.
Yeah, just a quick 101. NDAs, where are you signing them? What multiple of debt would you take on to make an acquisition? And what's your timing? Your fiscal year starts in about 3 weeks, so just always curious. Thank you.
So we continue to look at M&A opportunities. Jennifer mentioned Cotsworths, which we thought was a great fit with our organization. I think we will look at other component companies that fit well with which have a technology leadership position and add to our capability in Mario. So we stay active in looking at that.
Excellent. Well, I think we're just about out of time, but thank you for today, and we look forward to having you back next year.
Thank you.
Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes.